Hi, Level Up community. This is Marvin Jim Kabudsan, a tax consultant from the Unified Global, and I'm here to discuss ISO when the fair market value equals strike price. Here we have our client, Anna, who just received her incentive stock options from her company. Can you help Anna with this? She said that my company isn't public yet, so my exercise price and the fair market value price are the same. Now we can see here an example that we can give to Anna with regard the transactions related to the ISO that she currently have when the strike price is equal to the fair market value. The grant date of the ISO is February 1, 2024. It has 4-year annual vesting with 1 year cliff, 25% on each vesting date. She was awarded 100,000 shares, and the grant or strike price is $2 per share. The ISO's first vest date is February 1, 2025, wherein 25,000 shares has vested. On this date, Anna bought 25,000 shares at $2 per share. Now we can see that the grant strike price is $2 per share, and the fair market value of the said shares is also $2 per share. Now, if the client exercises when the strike price is equal to the fair market value, and the client decided to hold this ISOs, we can see in this slide that there are certain items that we need to note with regard to this transaction. Again, the number of shares purchased was 25,000, which was the vested quantity of the ISOs. The purchase price and the fair market value at the time of the exercise is the same at $2 per share. As tax professionals, what we should know first is the basis of the shares exercised. Again, it is $2 per share, meaning the total basis is $50,000. What is the fair market value? Again, it is $2 per share. Now, is there ordinary income tax when buying these ISO? The answer is no. Why? Because the purchase price and the fair market value at the time of exercise is the same or is equal to each other. Is there alternative minimum tax treatment when buying these ISOs? No, because the purchase price and the fair market value at the time of exercise are the same. Now, will taxes be owed by exercising these shares? The answer is no. What can we talk to Anna about is first that when she exercises these ISOs, she may need to have cash to buy these shares. So since the vested amount or the vested quantity of the ISOs are 25,000 shares, then Anna should need $50,000 to exercise these ISOs, these vested ISOs. So that is computed by 25,000 shares multiplied to or by $2 per share, totaling again to $50,000. Again, since there is no delta between the strike price and the fair market value, Anna will not incur any taxes related to this exercise of the ISOs. What do we need to file on the upcoming tax return? Nothing, and no taxes will be owed since the strike price is equal to the fair market value. What do we need to track for the future in case when Anna decides to sell the ISOs? We need to track, of course, the basis, which is the $2 per share or the $50,000, and when was the date of purchase. Now, Anna decides to sell these ISO shares that she exercised. What will Anna be going to do? Anna has 25,000 shares that she exercised at the price of $2 when the fair market value at the time of exercise was $2. Let's go back again to what we know. The basis is $2 per share, which is $50,000 total. The fair market value is $2 per share. And there is no ordinary income tax when she bought these ISOs because the strike price and the fair market value are equal. There is no alternative minimum tax treatment when she bought these ISOs because the strike price is equal to the fair market value price. And there were no taxes that Anna owed when she exercised these ISOs. Now she decided on year 8, she sold each share for $25 per share. What do we know now? We knew that when she purchased it in year 1, she purchased 25,000 ISOs, exercised this at the amount of $2 per share, the strike price, when the fair market value was $2. The total purchase cost was $50,000. What do we know about the sale? Anna sold 25,000 shares, all of the shares she exercised on year 1, and she sold each share for $25 per share. So these are the things now that we should know when the client decides to sell the ISOs she exercised. What is the total gain to report? Is it considered to be short term or long term? What tax strategies are possible related to this sale? Knowing these, what else should we recommend to the client? Now we will use this form 8949 to report the sale of the ISO stocks that Anna purchased on year 1 or in February 1, 2025. She sold this on February 2, 2033, with the total proceeds of $625,000. And the cost basis that she will be reporting in Form 8949 is 50,000 pesos. So what is the total gain to report? That is the difference between the proceeds of 625,000 computed by 25,000 shares by $25 per share and the cost of the ISOs exercise of $50,000 computed by 25,000 shares by $2 per share. Is it considered short term or long term? Since the date of sale from the date of acquiring these ISO stocks was more than 1 year, then it is considered as long term. What are the tax strategies possible? We can check with regard the qualified small business stock and any opportunity zone. And Anna may be required to pay estimated taxes related to the sale since there was no withholding related to the sale. So it is shown here on this graph that there is a long-term capital gains because the sale happened more than 1 year from the date of acquiring the ISOs. Let's go back again when Anna bought the shares. Anna needs to have cash to buy the shares. That is $50,000 computed by the 25,000 shares vested by $2 per share, which is the strike price. There was no taxes that Anna paid regarding these exercising of the ISOs because there was no delta or there was no difference between the strike price and the fair market value. Remember that the strike price on this transaction was equal to the fair market value of the ISO. There is nothing to report on the tax return related to this exercising of the ISO, no AMTs, no taxes owed. Why? Because the strike price is equal to the FMV or the fair market value. We need to track the basis, the $2 per share, and the date of acquiring or purchasing of these ISOs. When Anna sold these ISOs or these shares at $25 per share, we can now compute for the capital gains. How do we compute it? We deduct the total proceeds of the sale, which is 625,000 computed by 25,000 shares by $25 per share. from the stock basis, which is the strike price, $2 multiplied by 25,000 shares, or the total cost basis of this transaction is $50,000. Determine now whether we should identify this capital gain as short term or long term. Since the date of sale is more than 1 year of the from the date of acquiring these shares, then we should consider this as long term capital gain. Now, does it qualify as qualified small business stock? Does it qualify also for opportunity zones? These are the two tax strategies that we should also consider when there is a sale of shares, or particularly the ISOs exercised. We should also, or Anna should also have estimated tax payments regarding or related to this sale because there was no withholding that was made regarding this sale. What should we file on the upcoming tax return? We should report this gain, this long-term gain, to Form 8949. So I hope that we have understood the the items that we need to be talking to out to the client with regard when the ISO was exercised, when the strike price is equal to the fair market value, and or she decides to hold it, and when the client decides to sell the ISO exercised. So that's it for today with regard the ISO when the fair market value equals strike price. Thank you very much.